make sure that's good to go. And then, so first thing I kind of wanted to talk a little bit about, because I got some questions, is USD JPY, specifically the yen dollar, the relationship between them, and kind of why the Japanese yen is honestly depleting as a currency. So one of the first things to go over is just obviously like how bullish Japanese yen has been in ages now. And typically, so if you don't know, within the last probably 2 years or so, we've entered a high inflationary stage in our economy. That was within the yen as well as the US dollar. And when high inflation hits, one of the main ways historically to kind of combat that is by using interest rates and typically raising them. And what this does is when you raise interest rates, it makes it so the cost to borrow money is significantly more. And so what that does is it actually cuts down on consumer spending. And the reason being, obviously, is with businesses or even the day to day consumer like us, if you increase the amount it costs to borrow money, this includes credit. The majority of at least American citizens are highly utilizing credit on a day to day basis, and it enforces spending if credit rates are lower. But when you raise interest rates due to high inflation, the goal is to slow down consumer and business spending to then combat inflation by lowering supply and increasing demand. Um, and it is kind of a supply and demand issue at the end of the day. So when interest rates are very high and consumer spending is low, that means that the demand decreases, which means the supply can increase, and vice versa, with inflation and interest rates when it comes to low interest rates. So if interest rates are low, more people are going to be borrowing money and spending, but this obviously drives the prices of things up if there's increased spending in the economy. So one of the things that the US did when we reached that high inflationary, I want to double check my audio is working here. I can see my, let's see. Okay. Okay. Just wanted to make sure it wasn't my mic, Esteban. No, I'm assuming it's solved now. No worries. But yeah, so when the US initially had this high inflationary period, as well as Japan, the first thing the US did was go and spike your interest rates, meaning that it's tougher to borrow money, with the goal of cutting down on consumer spending. And then obviously, in the past, historically, this has gotten inflation under control. However, the Japanese yen and how they managed it over there, they actually kept their very, very low interest rates and actually a negative interest rate, which they were essentially late to the ship. They didn't properly in time address the inflationary acts on their currency. This is why we're seeing such a negative impact on the yen and also a much greater impact on the US dollar, is because it makes it more appealing to other countries to move to US dollar, or exchange for US dollar because there's higher interest on that capital compared to the Japanese yen, which I believe the current interest rate is actually negative 0.01%. Which, yes, it is a negative interest rate, meaning when you and I go put our money into a bank, your typical interest rate is going to be like 0.1% or whatever. If you're in a high yield savings account or the money market, you're looking at roughly at the moment about 5%, little under 5% returns on your capital. In Japan, that negative interest rate actually means the more money that you're leaving in your bank, you're actually getting essentially a cut of that taken out by your bank every month or every year. And obviously that entices people to say, well, I should have no money in the bank, then no savings. I should go out and spend my capital because I'm going to get more use out of it. And that is kind of something that in a high inflationary state is obviously a very bad thing. As we talked about, the goal with high inflation is to stop people from spending, and that's done by increasing interest rates. Japan kept it the same, so them having a negative interest rate actually enticed more and more people to go and buy products, services, use credit, and it actually caused their currency to take a detrimental hit over the last few years. But they do seem to be in some form of a recovery state now, so we will see how that goes. And of course, with the US recently cutting rates as well for the first time in, I believe, 4 years, we actually just cut rates for the first time. But that's just a general basis of, let me see, of inflation and kind of what was going on with the Japanese yen. I do want to go over the spreadsheet sheet because I did get some general questions about that. So this is something I made the other day. See if I can increase it here. So the first thing I'm going to preface is I personally do not use spread in the sense of a 4-hour trading strategy, and the reason being is I personally just find it's negligible. When using the 4-hour, it's such a high time frame. I don't think you need to worry too much about this, and I understand it can be a complex topic. But what I do feel the need to explain it is because I have a lot of people that come to me with their orders and they say, how come I didn't get tapped in here? Or how come my stop loss didn't, or triggered early, for example, in sell scenarios, which is fairly common. So spread at the end of the day is a foreign exchange specific thing. It does not typically happen in the stock market, but in the foreign exchange, there's an ask and a bid price. And it's much larger depending on the currency pair that you're operating on, of course. So your lowest spread is going to be on your highest liquid pairs, meaning euro US dollar, pound US dollar. And of course, liquidity means the amount of capital circulating through that market in a day. So currencies like euro US dollar, which I believe make up about 30% of the money in the entire foreign exchange market, which is roughly $2.5 trillion a day, just being exchanged within euro US dollar alone. It's highly liquid, meaning that your spread is going to be much thinner and much more negligible when it comes to your trading. However, as people who trade the 4-hour strategy and utilize a lot of trading pairs, this can definitely vary. You're going to end up trading some pairs or having some orders on pairs that have much higher spread, and that's when this will become more noticeable and not necessarily cause issues, but will cause some confusion if you don't quite understand it. So that's why I want to go over it. Now, number one, spread is simply just the difference between the bid and the ask prices. So ask is where sell orders will trigger. It's what a seller is willing to pay in the market. And then bid is where buy orders will trigger. And your typical price when you look at it will be roughly in between here, which is fairly negligible. It's such a small value or discrepancy. But generally, spread is just the difference between bid and ask. So on buy orders, and if this is losing you, I want you to shut off your brain. Don't let it confuse you. Don't let it complicate you. And if you're really getting confused and lost in this topic, just focus on this piece right here and this piece right here, which all it means at the end of the day is if you're taking a buy order, and especially for those of you maybe trading on the 15-minute time frame, this is more important. But if you're taking a buy order, simply add spread to your entry, and then you can keep your stop loss in the same spot. So what that might look like is when you have a buy order here, and we can see the Fibonacci, most of us here use this and enter at the 75%. Instead of putting your direct entry at the 75%, it could hurt your RR slightly, of course, doing this, but you can move this entry slightly above where you intend on entering and just account for the amount of spread that's in the market. So for euro US dollar, on average within the New York overlap, which is one of the tightest spread times, you're looking at like about 0.03 pips or 0.3 pips. So very, very small. It's just a dash above this line. The only thing that will do is if price were to come down to your entry, tap right on this black line here, and then run, you actually would not get entered into that trade, even though your analysis was perfect and had the exact point of reversal in the market at your entry. Even with perfect analysis, you would not get tapped in because price actually needs to go that 0.3 pips below to trigger you in, which is where the bid price is. So your broker entry in this example. That's why you can see here the blue dot represents where you will actually get entered in the market. So if you had your entry at 75%, price would actually have to dip slightly below that for you to get triggered into your order. I did see this happen a few people with EuroCAD on this initial tap that happened right on this area here. At least nobody of my knowledge got tapped in, and that is to do with what we're talking about here in spread. However, price did work its way back down lower, and I got tapped in on this low here. But even then, it was quite close because, I may not have gotten in here if spread widened just a little bit more. But I did end up getting tagged in on that second move, that small wick below. which is similar to what we're seeing here on this image, where price comes slightly below to get the entry. And stop loss, though, in buy positions, your stop loss is perfectly fine. You can keep it the same. And if you do, you can adjust your TP. I personally never do. Like I said, this is fairly negligible for those of you on the 4-hour time frame. It's not the biggest deal, and I don't think it's going to cause too big of an issue in the long term when it comes to your data. But of course, in the sell side operations here, it's going to be the opposite, meaning that your stop loss will actually get triggered before hitting it, which this is a huge one, because I can't tell you how many times I've been mentoring for years and years now, and I cannot tell you how many times I've had people send me images with their stop loss not hit yet, and then price runs their direction, and they're all upset, asking me what happened, why did this occur, especially when they're on those lower time frames, 2, 15-minute, or 1 minute. And this goes back to what we talked about with bid and ask prices. So when you sell any type of currency, your stop loss acts as a buy position now. So we can do the same in the buy position. If I were to buy $10 of Euro USD, if price keeps going down and down to $9, $8, and I want my stop loss, I now sell for $8 and I take my loss. If you guys can follow that. So I'm buying the $10, it's dropping, gets down to $8, and I'm like, okay, I'm done. Just sell it, take my stop loss, and I lose the $2. So you're buying here, but you're selling at your stop loss. It actually works the same way in a sell position, obviously. So in a sell position, you're selling the contract to exchange this currency, let's call it Euro US dollar, at this specific price. And then if price goes up and away from your intended direction, eventually you're just going to buy back the currency at that loss price and take the difference between the two, taking a loss. So buys and sells, of course, are opposite, but when you're including spread in the scenario, yes, you can get stopped out slightly before your stop loss or your intended analytical stop loss is triggered, meaning that, obviously if you do this in-depth analysis and you assume that a protected low, for example, in my Euro CAD trade that I'm in at the moment, all my analysis led to this position or this low holding. But in a sell side scenario, if I were to go and invert my chart here, yes, technically speaking, if price came up right about here and then dropped, I would probably be taken out at stop loss. And that's just kind of what spread is, and something to be aware of. Like I said, it's not too important on that 4-hour time frame. But for those of you who are trading those 15-minute time frames or even lower, it's definitely going to be something that has to be taken into account. For me personally, when I used to trade the 5-minute, 15-minute, I would always take my stop loss, my entry on a buy and slightly drag it above my analytical area that I expected price to come to. And that is because, like I said, if it perfectly tapped my entry here, I would actually not get into that because of spread. So that's just a brief breakdown of it. And then one more thing I'm going to mention is spread hour itself as well. So spread hour is 5 p.m. Eastern Standard. That is my time zone. But for those of you in different time zones, it's just when New York session closes. And this is when liquidity is going to be the absolute lowest in the market. So you will see spread spike significantly. And typically this is where these are going to be exaggerated in the sense that, I'm not sure if you guys have ever seen something like this where, say my entry's here, I got this crazy wick that went all the way to my entry and then price drove very high. If this was during spread hour, the spread might actually be so wide from this low to this high, for example, that I still could not get triggered into this trade, even though there's a ridiculous wick into my entry and then price runs. And obviously in a stop loss scenario, this works the same as well, where if there's a high amount of spread in the market because of the low liquidity at spread hour, you can get stopped out of your trade much, much earlier than where your stop loss actually is. And this is why it's just something to be aware of, but not something that I think needs to change your 4-hour trading strategy too much. Sorry, I'm taking a drink of water here because I'm like choking. So that's just a brief overview. This graphic, for some of you that haven't seen it yet, it's in other topics. I'll actually just link it right now. I had a very old version of this, probably about 4 or 5 years old, and it was nothing in detail like this. So like I said, don't let this confuse you. If it's something you look at and get a little stressed about it, just like I said, focus on these two pieces right here. That's all you really need to know if it's something that you want to take into account. I know there's been a few trades this week that actually had spread affect the entries of them. Even for some of you in EuroCAD, you may not have gotten tapped in uh, due to spread. So I get a lot of questions about it. I just want to make sure everybody's on the same page with it before moving on. And one of the next things I wanted to go over, let me check my agenda that I wrote down for today. So journaling in the jump from backtesting to demo or live. This is another thing I got some questions on. I know Justin was one. He's not here for the webinar. I told him obviously it'll be recorded and he can watch it back. But there's a few things I want to make clear, and we're going to start with backtesting. Now, for those of you who have been backtesting and kind of getting the hang of it, I'm sure when you first started, it was not like that at all. Myself and Andre included, when we made an initial shift to a 4-hour trading method, our backtesting looked something like -1, -1, -1, -1, 8 more losses in a row, blown accounts, you name it, it was awful. And it's because we didn't quite understand the strategy yet, how it can be used, how it can be optimized. Him and I were basically just focusing on structure. And you could see if I just sit here and mark out structural highs and lows, it's like, okay, that was a miss. That's another miss. That's a loss right here because it reaches below, break a structure. Okay, maybe a break even, but then we break lower. So maybe I could take a sell, another loss. Like it can get rough. If you're just focusing on something like structure, you don't quite understand your time frame or the scale that you should be operating on. And in some cases, it's even more minimal where, some people might be operating on this sort of scale and looking very, very close in and saying, okay, well, I have my break of structure. I have my fair value gap right here. I have my liquidity like so. Take my 75% from the low to the high. From this low to this high. And then honestly, if you do operate, you would have gotten a nice winning trade here. But I do think, in my personal opinion, this is far too aggressive. But technically speaking, yes, it follows all the rules of our trading plan. So it's one of those things where I personally don't take trades too aggressive like that. I don't like those tiny ranges. I found them to work worse in backtesting. Obviously, neglecting the fact that this didn't candle close above the high. So yes, some rules weren't followed. But the idea I'm saying there is because if you take 3-4 different people, give them the exact same trading plan and tell them to backtest, you're not going to get identical data. However, if you give each of those 4 traders, maybe 3 months, they're practicing more, they're getting used to that trading plan, and then they backtest, you're going to start seeing very, very similar trades among them and data. And that's kind of where that learning curve comes into play. Getting thrown into a chart and told to backtest, you're going to do very, very bad. But of course, with time and practice, you're going to get better and you're going to start seeing the same trades as even myself, Andre, and Sven, and as the other traders who are using that same strategy. So it is a learning curve associated. And I want to make it clear that demo and live trading is the exact same thing, but it's even accentuated a little bit because now trading psychology comes into play. So one of the main things that I want to mention is even in backtesting, in that learning curve that occurs, if someone were to backtest 1,000 trades, 8 months straight, they backtested every day, every pair, 20 years of data. I hate to say it and I hate to be that person, but you will not be as good as the person who's already practiced on demo or live markets a little bit. You cannot take 1,000 trades in backtesting and expect to jump into a live market and absolutely kill it. I hate to say it, but that's just not how this works. A good example of this, if you're a sports player out there, let's call it football, and I sat down with a professional football player and we sat in a room. I had a little notebook, and A to Z, he told me every single thing he ever knew about football. Yes, on paper, it might look fantastic and I might be highly educated, but if I now go step on the pitch and try to play a game, does that mean I'm going to go and kill it from day one just because I have this little notebook of all these different notes that, validate different things in the sport? Obviously not, and trading is the same exact way. You need to really be in the markets and practicing to see that, to see the increase in growth within a live market. So the reason I mention that, I have so many people who backtest, and then they get discouraged when they hop on demo and it's not looking just like their backtested data. There was no psychology involved. There was no patience necessary. You know, there was no moving charts, there was no hopping on at a certain time of day per day. It was just one quick sit down session, no patience, you're just clicking through a bunch of bars of data and just watching price play out and slap some orders on. Now, when it comes to real life, you know, you're not slapping through 6 months of price now. You're actually looking at each individual day. You might have to head off to school, you might have to head off to your job, you might have the family to attend to. All of these things are slightly taking you out of that zone over and over and over, day by day. That's just one piece of it. And that's what we call being on tilt, when your psychology is not in the right place for trading. Another part of it is some people might get into a live market and suddenly feel a lot more confident and aggressive because they have so much backtested data. And they will show me their average trades per month in backtesting was 3 to 4. But then on a live chart, they're showing me 9 losses in a row and asking what happened. And I asked them, how come you went from 3 to 4 average trades per month to 9? And they're like, well, I took 3 bad losses here. I took 2 bad losses here because I wasn't following my rules. I was trying to just get into as many positions as I could to make profit and get my payout. All of these slight changes are more likely than not what's happening to a lot of you in your prop firm evaluations, but also just in live markets in general. Being on tilt is something extremely common, and I can't tell you how many times I've heard students of mine be like, oh, but you know, I have perfect psychology, something else is wrong. And then I look at a journal and I can clearly spot the 3 different things that are wrong, and they're all psychologically related in more cases than not. It is something that takes practice and getting used to. So my best recommendation for those of you that think you're only backtesting at the moment, maybe, is at least backtest with a demo account on the side. It takes about 15 minutes or less per day to hop on and set your trading orders. So, you know, there's no excuse to not have a demo account running on the side. Or for some of you that are even comfortable with it, maybe utilizing a very small live account, $20, $50, $100, whatever it may be, and gaining the confidence through that in a live market. And that way, learning both at once, your learning is going to definitely extrapolate and be much better than the person who backtests only for 3 years and then they hop on a live chart and start running into the same issues they would have if they did from day one. So I definitely think that's an important topic I just wanted to talk about a little bit. And then I do want to talk about how you can actually improve on your live trading, because that is the area where a lot of people seem to struggle the most. So I copied over my journal into an Excel sheet here for the month of September, and AU, GBP, AUD, Euro USD, USD CAD. We're going to go over some of these trades. Honestly, all of them are in the team trades channel, which I will link as well. But this is probably the most important section of a journal. And I'll admit, I'm a little lazy with the journal because I feel like I'm at a comfortable point in my trading. I don't have reasons for losses. I don't have, you know, I don't write essays about my wins and losses anymore. However, there are some cases where, for example, pound AUD, I mentioned how price was consolidating around the entry. You know, not necessarily a big deal. Created a new high is one on, let's see if I can pull up USD CAD here. Maybe I'll find it in team trades. Let's see. So this is a good example here where price came down, broke structure, consolidated for forever, but then it did break a new high. And I have personally found in backtesting that if a new high like this is created, in more cases than not, price may end up reversing because we just grabbed a lot of liquidity. We grabbed that high very impulsively and broke down. So more likely than not, the majority of liquidity in the market now rests at the low, especially in the bearish trend, taking it into account. Now, not all scenarios, number one, thing to keep in mind, it's not making an excuse for a loss. It's writing it down so that in the future, if I end up having, let's say, 1,000 more trades on here, but I notice that I have a ton of losses with trades that have the note created a new high, this is simply telling me that in the long term, I may be better off avoiding trades that have a new range high. And this is how a journal should be used. A lot of people seem to be confused a little bit about that. A journal is not something where you just kind of blatantly write shit. It's something where you're trying to find the little details in different trades. And over time, you're going to start seeing those compile on each other and get some good conclusions that you can draw from live trading, as well as from backtesting, which can help some of these things. So my journal personally, like, still active on EuroCAD, consolidating around entry. I typically write this because I find that the majority of my trades that do something like this and have very low volume around my entry, they're going to end up breaking even and reversing. And that's something I've just found through data. So it is important. I had a student show me their journal recently. Sorry, I got a question from someone. Badir requested to speak. What's going on? But
Hello?
oh, what's going on? I didn't even know I could do this. See you,
Bro, I
man.
didn't even know. To be honest, man, I didn't even was supposed to talk. Like, I don't know how you how you came up with that.
Yeah, I didn't even know. I haven't used the what's this called, the webinar channel much, so I still got to learn it a little bit. But I did have a
Yeah.
student this week, and he was showing me his journal. And first off, it wasn't very bad, but I will say he had about 4 to 5 losses on there. In his note section, it said didn't candle close above the high, didn't have fair value gap, you know, didn't have a sweep on liquidity. And the more that you have 50 trades or whatever on your live account, and you're seeing all of these things add up, it's not necessarily an issue of, oh, I'm just bad at live trading. It's okay, I need to get my psychology in place, take trades that represent my backtested data more and more, and try to narrow down the bad notes on each of these trades. So, for example, being able to say this was a good loss is very, very important. AUD USD was my first trade of this month. Let's see if I still have the analysis. I don't. Where was it? Right here. So it was from this low, great sweep on liquidity, to this high, and then price just ran right through my stop loss. Some people, and this is the big difference here, don't be the trader who then goes and makes an excuse like, oh, but we took a large scale liquidity high over this end, and we weren't in the premium or discount of this range. All of these things are going to add to your trading plan and just increase the complication of it, and you will never find peace in your trading. You need to be the trader who can look at this and say, you know what, followed all my rules. Looks like a trade I took last week in backtesting. Perfectly fine to take that loss. That's your goal with the journal overall. However, if you look at this trade and realize, man, there was no candle close above the high, or the sweep of liquidity wasn't there, or there was no fair value gap, these are the things that you need to bring to the surface using your trading journal, and then utilize that to down the line realize, okay, I've taken 6 losses now that were unnecessary losses, and it's because they all didn't have fair value gaps, and I've been ignoring that rule. If you can see that, your goal is to cut down on those types of trades, and that is what is going to lead to those incremental changes long term that leads to your consistency using that trading plan. So it's all about those small adjustments, especially on a live account. And when you already have a good idea of your trading plan, those small adjustments are going to lead to long term better data overall. And it's one of the most important things you can do. Another one is people missing trades, missing winning trades specifically. If you miss a winning trade, it is 3 times as detrimental to your data as losing a trade. Obviously, we trade 3 risk and reward here. So if I miss a +3, that is 3 times worse than taking a -1 or even missing a -1 in that case. And you need to make sure you're in on the winning trades. And if you're missing them consistently, if you're looking in chat and you're seeing someone took a EuroCAD winner.
Met die wat?
Met die AI.
I don't know if
Alle?
Makkelijker op.
Op een gegeven moment heeft hij gewoon uitgesloten.
But say you are looking in chat and you're seeing someone took a EuroCAD winner, someone took a NZD USD winner, and someone took a USD JPY winner, and you're missing all of these winning trades. I don't want to call specific people out in chat, but there are people who I'm seeing in chat and they're mentioning, oh, I forgot to place the order. With swing trading, you have days on end to place your orders. In more cases than not, you didn't necessarily forget to place the order. You just might have not had the confidence to execute when you first saw it. That's honestly the reality of the matter, and it's one of those things that does need to be dialed in on to see that improvement overall. So don't go, I hate to say excuses, don't go making excuses and saying things like, oh, I missed placing EuroCAD. I can understand in some cases trades are missed, but in a case like this, the actual break of structure occurred, let's call it Monday, September 16th. It didn't tap me in this trade until the 26th, 10 days later. 10 days of analysis and breezing through my charts and looking for setups. Someone should be able to spot this order. If they didn't and it didn't follow their rules, that is perfectly fine in a different story. But if it followed all of your rules and you didn't place the order out of fear or out of, I don't like, it's not 100% perfect, or nitpicking and getting too in depth with your orders, those things are what's going to hurt your data longer term. And the worst of it all is not being real with yourself and understanding that, okay, I bitched out of this order. Because at the end of the day, it happens to all of us. I've done it forever. There's still orders that come around. I bitch out of them and I watch people take winners that I missed out on. For some reason, I do feel like, not this one, someone showed me an NZD USD winner. Maybe it was backtesting, but it was an order that I completely missed. Maybe it was backtesting. Trying to think. Yeah, it looks like it might have been, because I don't see anything in this immediate range. But it's one of those things where I saw it and I was like, how did I miss that? It was a great setup, had all my rules there. That's human error at the end of the day, and human error is inevitable. Sven, when he does his backtesting sessions, you'll hear him talk about, subtract a few losers, subtract a few winners. Your data is going to be worse in the live markets than backtesting. Could have been a skill issue too, like Badir said, it's possible. But in general, I just want people to understand that it's not necessarily a trading plan issue. If you're on a live account and you are not seeing profitable data, but someone using that exact trading plan, myself or Sven or Andre or other profitable and funded traders that are in chat, if they're using the same plan as you but profitable, it doesn't mean the plan doesn't work. It means that you might need to dial in a little bit on those minor discrepancies, get better with that trading plan to a point you can trade it profitably. And this will go for any trading plan there is, regardless of how mechanical it can be, especially in the smart money space where trading tends to be a little bit more discretional. I do feel a lot of people I watch or look at in my DMs or whatever it may be, they will send me data and say, why am I doing so bad on my demo account or in my funded evaluation? And I say, okay, so the losses don't look bad. There's a few bad ones here and there. This one didn't follow the rules, that one didn't follow the rules, and that one didn't follow the rules. Wipe away -3 right out the gate. That's something that would, in time, if you get better with your trading plan, wouldn't have been there. You would have 3% more profit than you already have. The other thing is, I say there was about 7 winning trades within the last 2 months or so, and they would have 0 on their data. And I say, so what is the issue of missing these winning trades versus taking all of these losses and even worse losses? And in more cases than not, they don't have the confidence in their trading plan to execute on the proper positions that follow all of their rules. They're doing what's called nitpicking. They're looking through their watch list and they're saying, technically, Euro NZD sweeps liquidity, breaks structure, has a fair value gap, but like, yeah, I'm gonna wait on that one. I don't know. We'll go to the next one. And then they go and look at the next one and they don't take it. But then a week comes by, they see price retrace right up, fill the fair value gap, run to their TP, and they're kicking themselves saying, oh, I forgot to place the order. You didn't forget to place the order. You let yourself sweep it under the rug and kind of moved on to the next thing. Let your mind get the best of you. That is trading psychology in a very minimal fashion. There's so many other psychological factors that will affect your live trading, but that is a main one that I really, really want to stress because it's one of the biggest ones that I see, especially when it comes to that whole idea of missing winning trades and taking more losers. And that is what's going to, over time, compound and improve your live trading data or your evaluations. Is there any questions about anything I just went over? And then if not, I can kind of go and break down my watch list here, see if there's any setups that I can be looking at. I actually do like Euro NZD. I just randomly pulled up this pair, but it does look good. And then I guess I can go over some of these trades here, which for some reason it's not opening the hyperlinks. Pretty sure. All right, it's just a weird. Here we go. Oh, sick. I don't know why it's not available. But I will pull them up through Discord because most of them are in that team trade section anyway. So let's start with AUD loss. We already actually went over this one. So here's my AUD USD loss. Let me actually pull up all my orders this month so we can kind of just go through them. So CAD, Euro CAD, I can pull that up on a live chart because I'm already in. and then pound AUD. So we'll start here. This should be in order actually of the month as well. Let me check. What do you think about pound NZD? The setup that I took in one. So I actually missed that one. But here's the difference that I want to make very clear. I didn't miss this one because I wasn't looking. I bitched out of it. XYZ. Personally, you guys hear me say it a lot. I don't like sideways markets. So that's why I sat out of this one. And once again, I'm very okay with missing the winner in this case. I don't like markets that look sideways like this. You guys have heard me say that for a very long time. So it's perfectly okay. And it's not something that you got to go and beat yourself up over. The next thing, and good that you didn't take it, honestly, because I think one of the worst things a trader can do is sit out of a trade for a concrete reason that they know from their backtesting. I know that in more cases than not, I lose trades in a consolidating market like this, so I sit out, and I'm perfectly okay with that. However, don't be the trader that now looks at this trade and they're kicking themselves because they're saying, fuck, I should have just taken it, followed all my rules, it had the break of structure, it has a great fair value gap, swept liquidity, like, I don't know why I'm not in this trade. I'm a terrible trader, I missed it. You're just ruining your psychology for yourself, and it's not something that you need to be worried too much about. I'm perfectly okay with missing it. Hopefully you are as well, so don't kick yourself over stuff like that. You have to be, this is where confidence comes into trading. I'm perfectly okay with missing a trade and confident that I still have that edge long term. I mean, I'm still up 8% for the month. I'm not going to go and kick myself because I'm not up, what is that, 14% if I hit the 6% trade. It's not worth it to me. At the end of the day, I'm still up in profit. However, what could have happened is if I went and took this trade, my data shows more likely than not I would have lost, and now I would have gone from 8% profit to 6%. I'm perfectly okay with sitting out on that risk of taking the -2 versus the +3. It's just how I trade. It's from the data I've collected. However, there's some people who you've seen in chat who took the trade, they made out, and they made their 3% or 6% depending on what they risk. And that, again, is not a bad thing. What they did is they just worked on their own experience and said, well, it follows my rules. I took this in backtesting regardless of consolidation, so I'm going to go for it. They get paid out for it. That's the discrepancy in trading that a lot of traders need to get very comfortable with. And especially when operating within a community like ours, everybody in this community, for the most part, is trading the same strategy. So you can't go and beat yourself up looking through chats in here and saying, oh, he took a trade that I didn't and won. There's plenty of trades that you probably took that he didn't and you won. It's just how a community works. The grass is always greener is the term. I do think one major advantage is that everybody here is trading relatively the same. I've been in communities where everybody has a different strategy, and just imagine watching people, quote unquote, take or win, because I will be honest, 90% of the people in those communities, although they might have 100 RR marked up on their screen, it's not the reality of their trading. They're just not catching 100 RR a day. Whether they like the promotion, they're trying to sell their own product, whatever it may be. But imagine seeing that over and over of people catching 100 RR supposedly every day in a community with their own strategy. How many traders do you think at some point when they're in drawdown periods are going to break and go trade the way that that person does? And then they're going to run into the same exact issues. They're going to not be catching 100 RR a day, realize it's not the reality of it, and fall into a detrimental cycle. Confidence in your trading, sticking to one trading plan, I promise you, is 99% of the trading industry overall and succeeding in it. All the rest of the social media and garbage on there is why traders are failing so much more often than ever. We have channels like ICT with millions of subscribers. He teaches great analytical concepts, but why is there not a million funded people out there? It's because people are overcomplicating the strategies. They're constantly changing from the silver bullet method to his new method that's probably going to come out next week to the next one that he'll come out with next year. They know how to market and operate. It's just one of those things that I really want to drive home is stick to your strategies, create confidence through backtesting, and then practice on demo, and you will be forever successful compared to the trader who is switching up his strategy every single month, week, or year. And then for Tomas, question regarding swaps. Do you think they can affect long-term profits? In my personal opinion, swaps are very negligible. They're not something that has destroyed any type of profit on my live accounts. Obviously, if you're in a trade, I had someone ask me this. I've never seen it myself, but they said if your swaps are taking all your profit and you're negative on the trade now, should you close it? I've never seen this in my life. But of course, yes, if that's the case, swaps are something, in my opinion, though, that's very negligible, and I don't typically pay too much attention to it when it comes to my live trading. All right. Sorry, I need a drink of water there. I'm like losing my voice. I feel like I talk too fast sometimes in webinars. I end up like losing my own voice here. I'm going to mark up this trade here because this is something that I would be interested in taking. From this high to this low, mark my fair value gap. It's another thing too, just a very easy and simple tip. If you are going to take a setup, mark every piece of the trading plan for it, and it's very, very easy for those traders I mentioned who like forget that there was no fair value gap or forget that there wasn't a liquidity sweep. If you just do what I did briefly, mark every piece of the trading plan. Okay, liquidity sweep, break of structure, candle close, fair value gap, 75 fib, mark the high of my range, mark the low. You can't accidentally forget rules in that case. You're going to go to mark it up and be like, wait, where's the fair value gap? I don't have a purple box on my charts. And you're going to realize, okay, this doesn't follow the rules. Very simple, brief tip, but you'd be surprised how many traders I see that don't utilize that. So I'm going to remove this one now. So this is a break even for those of you that don't know. Let's actually go over these first, and then we'll breeze through. So once again, like I said, I mark every piece of my plan. I have the liquidity sweep here, break of structure, fair value gap, and then I mark my low to my high. And then obviously this was the high of the range. Price kept running up and up, so I dragged the fib. And then price came down. That's a -1 or -2% on my personal account, -1 RR. And then this was my next trade that I had for this month. Consolidation area, which represents great liquidity. I always talk about this. All of these lows in here, a lot of sell side orders rest here. So when price is driven through that, there's a large amount of buy orders that can be utilized in the market now to push price very heavily upward. We break structure, and then we form once again a low and a high of a range, a break of structure, a liquidity sweep, and then a fair value gap right near my entry too, which is very nice. Price comes back into it, tapped me in, and then I ended up taking the plus 6% here. So -2% followed by a plus 6%. However, one thing I had some people do is September starts, it's a fresh month, they might be on a fresh evaluation account, whatever it may be. They took that -2% and they said, shit, I'm already down 2%. I need a really, really good trade here. I can't go and take any ugly looking trades. Then this trade came around and they said, well, you know, maybe the break of structure wasn't good enough. Or, you know, maybe this break of structure also wasn't good enough. And they sat out and they end up missing this trade because of that. You can't let the slight psychological factors come into play and affect your data. You gotta almost try to trade like a robot here and take the trades that follow all of your rules. I had Euro USD here, which was a sweep on liquidity, very aggressive move, break a structure downward. Once again, this is another scenario where I saw this in chat, so plenty of people did spot this trade with me, but there was also so many people who were like, I don't like it, which is fine. It's perfectly fine, like I said, but you got to give a concrete reason of why. Oh, I don't like it, you know, because it's counter trend. Have you taken counter trend trades in backtesting? If the answer is yes, then take it. If the answer is no, I'd like to see your data because I don't think it would be very great. But a great sweep on liquidity here, range high, range low, break of structure, fair value gap, once again, right around entry. Price comes up into it. I actually did get tapped into this because of the spread conversation we had earlier. And then price ran and hit TP, another 6% there. So I was up 10% among these three trades at the start of the month. Then USD CAD. Once again, great impulsive sweep on liquidity. I love wicks like this that come and sweep a bunch of consolidation areas like this and this. Wicks show very high volume in the markets, which can only be created by institutional involvement, and then a very strong break of structure up. I typically don't like one candle breaks of structure, but with how much consolidation occurred here, I was letting it play out. And then price ended up coming a little bit higher, making a high here. So I dragged my fib, took my entry, fair value gap right around the entry again. And in this scenario, we tapped in, didn't quite get to that 1 RR reaction, almost made it there, but then a -2 as well. So overall, up 8% with these trades. and then still up 8% because this is a break-even position here. So we had a sweep on liquidity that occurred. We have a break of structure. Once again, fair value gap right around that entry level. Price worked its way up and up, creates that new high. So I drag the fib to follow the low and high of my range. Price works its way back down, taps me in. We make that one risk to reward break even level. And then we kind of just dilly-dally, consolidate around, didn't do much, and then eventually came back to tap me at break even. No harm, no foul. When I do log break evens on on my journal here, I'll always just put like a 0.1% or something other than 0%. Just because I obviously don't include swap in this journal, but 0.1% in most cases, it just shows it as a win in my data, and I do like to include break evens in my win rate because it was a chance at making 3 risk to reward with losing only 1%, or with the risk of only losing 1%. In my opinion, losing nothing with the chance of making 3x returns is a win in anyone's book. What a great month. Yeah, it has been a really good month. Obviously, I've shown like June before was a rough month for me. So not, trust me, not all months look like this. For those of you risking 1%, you'd be up around 4% right now, which is a fantastic month overall too. Taking similar trades. Obviously, mine is a little bit skewed because I do risk double the amount per trade, but I am on a personal account and I just kind of prefer to do this to greater leverage my capital. But overall, some people with 4%, it's great. August, I had a pretty good month too. But then when you look at June and July, not so great. July, I was up slightly, and then June, I was slightly negative for that month. So it really is one of those things. Or July, I was break even. June, I was slightly negative. I don't know if I said it backwards or wrong before, but it is one of those things. You got to be okay with June being negative, July not making much, but then August and September come around, they pull you out of that drawdown or that slow period, and then you go and get to make great profit on top of that. Trading is a very inconsistent business, like any business actually. For those of you that don't have other businesses, in in real estate, for example, there can be great months with many deals followed by some months with almost no deals. And it's one of those things where the common inconsistencies is why I think spreading your income is a great idea. And it also is much easier on you psychologically. If I had bills to pay in June and July and my only source of income was trading, you screw yourself. You back yourself into a corner of, okay, I didn't make anything in June. I didn't make anything in July. Now I have to do really good in August. Imagine how much pressure is on you to trade well in August and how many shitty mistakes you're going to make because of that pressure weighing down on you. I do highly recommend other sources of income. Prop firms could be a good example. Having a personal account on the side with prop firms. If you make money with the prop firm and get a payout, maybe go and funnel that into a long-term investing portfolio, funnel some of that back into your personal account, or start a side business, side hustle, whatever it may be. So you're not completely reliant on trading because it is a very inconsistent income. You don't want to completely rely on something that can go 2 months, 3 months without making you capital. The goal is long-term growing your account and growing your assets that you manage. And then 1 or 2 trades is obviously going to make you a surplus of capital when it comes to how much you may need. But I always highly recommend other income sources if you are going to be a trader. Firms are a great example of that. As you guys know, I personally don't use prop firms. I'm a US trader, and as far as I know, we're banned from every prop firm there is because the US doesn't like people making money here. But for those of you that are outside, I think utilizing different firms, trying to get passive valuations, get funded, and make small payouts from different firms, I think that's a great tactic. I was trading with my Forex funds for the longest time and scalping out payouts for years, and basically just taking those, funneling them into long-term investments, my personal account, and then I eventually started my real estate business using that capital as well. It's one of those things where people who are using their funds wisely and intelligently are going to far surpass the people who get their first payout and they went and bought a Gucci belt. I know, I hate to say it, but I know a guy who was FTMO funded, good friend of mine, good trader too. He was a gold scalper. He used to scalp gold in like the 1 minute time frame. He was very good with scalping out good payouts from FTMO, but he went and moved to, I want to say Ontario, or I think it was I'm gonna say Ontario. I forget now. He either moved from Ontario to another province in Canada, whatever it may be. He bought a penthouse and then got a Rolls Royce, and then ends up finding out that my Forex funds goes out of business, which is half of his entire income and assets under management. Yeah, Esteban's from Canada too, but yeah, he goes and finds out that half of his assets under management get shut down because of my Forex funds. Half of his income is gone. Completely screws himself. He has to go and foreclose on property, and it's a whole shit show. Use your money wisely. Don't go and inflate your lifestyle right away with these prop firms, especially because they're so unsustainable and something that isn't long term oriented. Be smart with it. Put it away into investments, into personal trading accounts. Even start a new business with it. Use it as income to get your income scaled. But please just be smart with it. If there's any takeaway from this webinar, let that be it. But is there any questions? I went through my trades for this month. I briefly went through some pairs. Is there any questions on trade setups you want me to look at? Anything I went over today? See, I don't see too much going on. Lots of consolidation in these in the markets. Like, see, I really don't like trading ranges like those. It's not a bad setup. Break a structure here. I'd like to see a little more structure above that high, but overall range high to range low, I can keep an eye on that. This is another good example of one. It is running a little bit far for my liking though. What about Euro AUD? Let's see. Yeah, solid sell position here. You're referring to, oops, sweep on liquidity, fair value gap. I'm very zoomed in right now. Break a structure. These my markups are sloppy right now. And then range high to range low. Something like that. A lot of the Euro pairs have similar setups. USD CAD. USD CAD has a bit of a larger range. It's not something I'm interested in. I also had some questions about UJ, and some people took the buys here. Oops. Some people took these buys here, and I do know some people took these sells from here to here. I personally didn't have either. I was not really watching UJ, to be honest, just because I don't like this this range that we were working within, and it wasn't something I was keeping a close eye on. I think honestly both of those are perfectly fine. If you're a more aggressive trader, it's perfectly fine to take those more aggressive ranges like that. If you are someone who takes a bit of larger ranges, kind of like myself, I do tend to take larger trades like pound AUD. Was a pretty large range. So maybe you would have been better off taking something like this. You would be at risk free at the moment. If this even, kept you in the spread, who knows how much the spread could have been on this massive move here. But not a bad trade overall, just not something I personally saw. Don't really see clear fair value gaps either. What do you do when you have a lot of Euro pairs and all of the trades present at once? Personally, I think my answer would be very different than Sven's or Andre's. I'm very conservative with my trading, but it's because over the years, I feel like I've scaled into my personal account pretty substantially. And with prop firm trading, I was able to manage very large amounts of capital with prop firm trading and not necessarily care because it wasn't my money. Now that it's my money and I'm operating with much larger accounts, I tend to be very conservative with my positioning. So if I saw, for example, breeze through my pairs and saw 6 setups this week, I'm not taking all 6. I'm going to start dialing in on the cleanest setups that follow my rules as nicely as possible. For other traders, though, I know some people, if they have 6 setups, they might say, well, I'll just cut my risk in half and take all 6. So instead of risking 1% on each, they risk 0.5. That's perfectly fine as well. Probably even the better way to do it, to be honest. Maybe if in the future I wanted to, I could cut my risk to 1% and take all 6. That's another good way I could do it. So it is kind of preference based. If you see a ton of setups, and I'm assuming you're talking about correlation as well, I personally have never been one to care for correlation. I have 2 sell setups right now on Euro NZD and Euro AUD, but you can see my Euro CAD trade is doing fantastic and very bullish at the moment. So I don't really care for correlation like that. I find especially you know, this could get a little bit into the mathematical side of things, but you have massive currencies like CAD and AUD paired to the euro versus a tiny currency like NZD. These currencies can move, or these pairs can move very, very different in unison with one another. For example, USD JPY shot down today, but you look at something like USD CAD, it barely moved today. It's because of the size of the currencies, and you got to think of them as a ratio. And realistically speaking, you know, US dollar is a massive currency paired with yen, which is a very, very small currency. So you're going to see a lot more erratic price movements. Obviously, yen has these crazy erratic price movements, very large sheer drops, great large drops. But then you look at something like USD CAD, and it's really not too significant, especially within the same amount of volume in day. So that's why I don't really pay too much attention to correlation. I've had so many trades where this could go and hit TP, but I had 2 sells here, so it doesn't necessarily matter to me. Sorry, I'm getting a bunch of DMs. All right, so if that's all the questions for today, I can give it a few minutes here and just wait, see if you guys come up with any more. But that might be it for today's webinar. So I'm gonna go and cut the recording here.